There are some people, especially beginner traders and investors, who rely on stock picks from friends or people who come on YouTube, WhatsApp, Telegram, Facebook, or X saying, buy the dip, or this stock is going to the moon. And before you know it, you jump into the charts and you're already thinking, maybe I should buy it too. Maybe because everybody seems to be talking about it, or maybe because the stock has been going up for weeks and you don't want to miss out. Now, here's the problem. A stock can look attractive today and still turn out to be a terrible investment. Over the last two videos, we talked about when to buy and when to take profit using the RSI strategy. But today I want to answer one of the most common questions I receive from beginners in my community. Before we even talk about charts, how do you know whether a stock is even worth analyzing in the first place? Because one of the biggest mistakes I see new traders and investors make is analyzing stock charts before they've even asked, is this actually a good company? The truth is, you can have the most beautiful chart in the world, but if the company behind that chart has weak fundamentals, poor earnings, declining sales, or too much debt, that investment could still disappoint you. So before I spend time looking for support and resistance, before I check RSI, before I look at candlestick patterns, I first want to know one thing. Is this a quality business that's worth my time and money? And that's exactly what I'm going to show you today. I'll walk you through the 5 important things I always check before I even open TradingView. Whether you are investing in NGX stocks, US stocks, ETFs, or almost any stock market in the world, the process is exactly the same. Welcome back to Trade with Raks. This channel is dedicated to helping beginners and intermediate traders and investors understand the stock market using practical strategies, technical analysis, and investing principles. If you want to become a smarter trader and investor, make sure you subscribe. Now let's get started. Here's a quick reminder. This content is strictly educational. It is not financial advice, and you should always do your own research. Before we talk about the 5 things I check, let me explain something very important. Think about it this way. Imagine you are buying a car. Would you first look at the paint, or would you first check the engine? I believe most people will check the engine, because no matter how beautiful the outside looks, if the engine is faulty, you'll regret buying it. The stock market works exactly the same way. A lot of beginners make the same mistake. They open a chart, they see a stock going up, they see green candles, and immediately they think this must be a good stock. But remember, a chart only shows you what investors are doing with the stock price. It does not always tell you if the company is making money, if the revenue is growing, if the company has strong management, or if the business is sustainable. This is why smart investors use fundamental analysis and technical analysis. Fundamental analysis tells you whether the company itself is healthy. Technical analysis helps you decide when to buy or sell. One helps you answer, what should I buy? The other helps you answer, when should I buy? Before we move on, answer this quick question. A stock price has increased by 100% in 1 year. Does that automatically mean it is a good company? Yes or no? Pause the video and think about your answer. The answer is B, no. A stock can rise because of hype, speculation, or market excitement. That is why we need to look deeper. Congratulations to those who answered correctly. Now, let me show you the 5 things I check on any stock before I analyze the chart. The first thing I check is revenue growth. I want to know if the company is growing. One simple way to check this is looking at the yearly revenue in the company's profit and loss statement. Revenue is the total monies a company generates from selling its products and services. So I want to know, is the company selling more products or services every year? For example, Imagine two companies, Company A and Company B. In year one, Company A generated a total revenue of 100 billion naira. In year two, it generated a total revenue of 130 billion naira. And in year three, it generated a total revenue of 150 billion naira. Now, Company B in year one generated a total of 100 billion naira in revenue. Year two, total revenue of 80 billion naira, and in year three, a total revenue of 75 billion naira. Now, which company looks healthier? Obviously, the company growing its revenue. Now, revenue growth alone does not guarantee success, but consistent growth tells you that the business is expanding and attracting customers. If revenue has been flat or declining for years, I ask myself why, because growth matters. The second thing I check is profitability. This is one of the key things I want to know. Is this company profitable? Is the company actually making money? This sounds obvious, but many people never check. If a company has been losing money year after year, that's a warning sign. For example, whether I'm looking at Jitco, Zenith Bank, Apple, or Microsoft, one of the first things I check is whether the business consistently generates profits. A company can have billions in revenue and still lose money. Think about it this way. If a company's sales increase every year, but their expenses increase faster, are they really becoming stronger? That is why I always look at the company's net profit, profit margins, as well as their earnings growth. A good company should ideally show the ability to turn sales into profit, because profitable companies generally have a stronger foundation for long-term growth. The third thing I check is the total debt. I want to know how much debt does the company have. Is the company drowning in debt? Debt is not always bad. Many successful companies use debt to expand, but too much debt can become dangerous, especially when interest rates rise or business conditions become difficult or revenue slows down. A strong company should have a manageable debt level compared to its earnings. Remember, a company can look amazing from outside, but too much debt can create problems behind the scenes. So far, we've only looked at the business itself, but the next thing I check is probably one of the most overlooked by beginners, and it has saved many investors from buying expensive stocks. The fourth thing I check is valuation. Is the stock overpriced? Am I paying a reasonable price? This is where many beginners make mistakes. A great company does not always mean a great investment. Why? Because you can overpay for it. Imagine buying an amazing house but paying three times its real value. The house may still be beautiful, but your purchase price was bad. The same applies to stocks. A great company can still be a bad investment if you're paying too much for it. That's where valuation comes in. I look at things like price to earnings ratio, also called the PE ratio. It doesn't tell you everything, but it helps you compare whether a stock looks really relatively cheap or expensive compared to similar companies. I also look at market capitalization, which is the value of the company. I look at growth expectations as well as industry comparison. The goal is not to find the cheapest stock. The goal is finding a quality company at a reasonable price. Remember, a fantastic company bought at the wrong price can still produce poor returns. The fifth thing I look for is what special thing does the company have? This is called competitive advantage. So I would always ask, why would customers continue choosing this company? Examples would be because of strong brand reputation, their unique technology, a large customer base, their strong distribution network, or market leadership. A company that can defend its position has a better chance of surviving long term. I also look for what story is the company telling. This is where I read the company's recent reports, earnings updates, and news. And I ask questions like, is the company expanding? Are they launching new products? Is their profits increasing? Are they facing lawsuits? Are they losing customers? Do they have a strong management team? What is their strategy? The story behind the numbers matters because sometimes the chart hasn't moved yet, but the fundamentals are already changing. Now, after checking the fundamentals and I'm happy with those 5 checks, then I move to the chart. This is where technical analysis comes in. Now, I start looking for better entry points, support and resistance levels, trend direction, momentum, RSI, moving averages, candlestick patterns, and risk management levels. Did you notice what happened? I'm not using the chart to decide whether I should buy. I'm using the chart to decide whether today is the right time to buy. That's a huge difference. Okay, for example, a great company can still drop more than 20%. If you buy at the wrong time, you may panic and sell at a loss. That is why I personally believe fundamentals help you choose the right company, but technical analysis helps you manage your entry and exit. Fundamentals help me build my watch list. Technical analysis helps me execute my trades. So you need both. Let's look at these examples. Now, imagine two companies. Company A has a chart that looks amazing. The price is moving nicely, and it might even be getting a lot of attention. But when you look beyond the chart, you discover that profits are falling, revenue is declining, debt is increasing, and the business is facing growing challenges. Now, look at company B. Revenue is growing, profits are improving, the company is generating strong cash flow and has a healthier financial position. But when you open the chart, the stock is temporarily pulling back towards an important support level. So, which one would you rather spend your money on? Personally, I would rather start with the stronger business and then use technical analysis to look for a better entry point. Because a beautiful chart does not automatically mean you are buying a strong company, and strong fundamentals do not mean you should buy at just any price. That is why I believe the real power comes from combining both fundamentals and technical analysis. First, use fundamentals to help you identify businesses worth researching. Then, use the charts to help you study the trend, look for a better time to enter, and manage your risk. That way, you are not simply buying a stock because somebody recommended it or because the chart looks exciting. You actually have a process behind your decision. If you're a beginner and you want a practical guide to help you improve your trading skills, I created the Trade with Raks Beginner Trading Workbook. It includes trading plan templates, trade journal pages, performance trackers, exercises to help you become a more disciplined trader and investor. You can find the link in the description below. Also, if you want personal guidance, I offer trading and investing coaching for adults and young learners from age 10 and above. The goal is to help students understand the market, build good habits, and develop a proper trading and investing mindset towards building a profitable portfolio. The details are available through the link in the description. One of the biggest mistakes beginners make is buying stocks because someone said, buy this stock or buy the dip. But before you invest your money, you should understand this. Why are you buying it? What makes the company strong? What risks exist? Because at the end of the day, nobody cares about your money more than you. So learn the process and build your own confidence. And before I wrap up, I also want to mention something for parents, guardians, and anyone who has a younger person in their life. If you're watching this and thinking, I wish I had learned all this when I was younger, well, that's exactly why I created Stock Markets Ninja Kids. It's a fun and beginner-friendly guide designed to introduce kids and teens to the world of money, stocks, investing, and building wealth knowledge early. Because imagine how different things could be if we didn't wait until adulthood before learning what a stock is, how investing works, or why building good money habits matters. Stock Market Ninja Kids helps young learners begin understanding these concepts in a simple, engaging, and age appropriate way. And no, the goal is not to turn every child into a stock trader overnight. The goal is to help them build financial knowledge, confidence, and smart money habits that can grow with them. So if you have a child, teenager, younger sibling, niece, nephew, or student aged 10 and above, and you would love to introduce them to the world of investing in a fun and easy to understand way, check out my ebook, Stock Markets Ninja Kids: How Kids Turn Allowance Money into a Fortune Before They Are 21. You will find the link in the description below. Because whether you're learning about investing as an adult or starting to teach a young person about money early, the most important thing is this: don't just follow the crowd. Learn how money and investing actually works. Let's quickly go over what we already discussed. So before I ever open a chart to buy any stock, these are the 5 things I check. 1. Is the company's revenue growing? 2. Is the company profitable? 3. Is the debt manageable? 4. Is the valuation reasonable? And 5. What's happening in the business? Only after I have done those checks do I begin analyzing the chart. Because successful investing isn't choosing between fundamental analysis and technical analysis. It's knowing how to use both together. If you found this video helpful, don't forget to like this video, subscribe to Trade with Raks, and turn on notifications so you don't miss future lessons. In my next videos, I'll show you how I combine this stock selection process with technical analysis to find better entry points before buying. Because finding a good stock is only the first step. Knowing when to buy is where many traders make mistakes. So make sure you subscribe. Finally, I'd love to hear from you. What's the first thing you check before buying a stock? Share your answer in the comments. Let's learn from one another. I'll see you in the next video.